For those of you that I haven't met, my name is Wayne Pinnell. I'm the managing partner for Haskell & White. And I'd like to welcome those of you in the room to our SEC Roundtable and a number of people that are joining us virtually this morning online. So as we get started, just to walk through technology already. Oh, there we go. All right, so for today, we're going to make sure you get your information on the CPE out the door. I think you see Leah at the back of the session today. She can help you with that. We'll get through some surveys at the end of it, so you can let us know what you liked and what you'd like us to change for future. Go through a couple introductions here in a moment, but today's topics are going to be two primary topics. One is going through the SEC's new directions and proposals that they have out there. So we've got what we're calling a fireside chat, which is two stools behind me without a fire, which is probably good because it's fire code. So, and then we've got a tax provision, new income tax disclosures thing, which does affect everybody. So we'll go through that. So, oh wow. Okay, somebody's controlling something on here. I see the movement. The arrows are moving around. Ah. Right, stop. All right, we'll try this. All right, so for CPE, make sure you have written your name on the sign-in sheet out by the door. Don't forget to pick up your certificate on the way out. If you're on Zoom, make sure you are paying attention and answer the polling questions that we'll have. You have to make sure you answer 5 out of 6 of them, and you'll get your CPE certificate by email. Just as a caution and a warning to those of you joining us from other states outside of California, you may or may not be able to claim that CPE, depends on the rules of your particular state. So about Haskell & White, for those of you that are new to us, again, thank you for coming. We are a middle market focused firm. We've got 2 offices, primary in Irvine, second office in San Diego. We have been known for a long time as a great place to work, and as of just the other day, we got notice of that again, that we've made it to the list of best places to work in Orange County. And the particular survey there it's 4 years running, so 4 years in a row. We have technical competencies we believe rival those of our brethren at larger firms. We try to train ourselves in the same way they're doing it. We've won many an argument against a large firm in terms of technical stuff. But we do work with a variety of public companies, both accelerated, non-accelerated. You're all here primarily for the public company side, but we've got a very strong practice in private companies as well as nonprofits. And we are very committed to quality. Sometimes it's hard to argue, hey, this is a quality audit, but the quality bears out when we go through our peer reviews and the inspections from the PCAOB. And just adding additional information, yesterday the Orange County Business Journal rankings came out for the accounting firms. In Orange County, I like the way they've changed the way they're ranking, but we now rank as the 15th largest in Orange County, and that's measured by number of CPAs working in the firm. So when you look at who is in front of us, it's a lot of larger firms, but when you look at the ratio of CPAs on staff to total, we are really, really strong in that percentage. In fact, it's amazing to me that some national firms with many more employees locally have like just a couple more CPAs. So that does put it back to what we've been doing in training and teaching and getting our people up to speed with what they really should be focused on in the profession. So today, I'm getting a lot of extra credit here as being a presenter, but we have Rick, Ryan, Brian, and Brian. Hey, that's pretty good. But one thing that stands out to me on this page is there's 3 numbers that popped out to me immediately when I saw it. There's a 40 plus, a 30 plus, and a 20 plus. All right, I got the 40 plus. So one of the things that I really have valued about this event is that it's been a peer-to-peer conversation, so we do ask you to engage in some dialogue. There'll be time for questions, I trust, but we are bringing together finance leaders, directors, advisors from our firm to talk to you about what's changing, and right now, is a time of a lot of change. A day doesn't go by when we don't see something new from the SEC, and there are quite a few things on their agenda. Some things have been announced. They're getting a lot of attention. There's some comment periods going out there, such things as shifting to a semi-annual reporting, and some other changes in the measurements of how big a public company would be to take advantage of other roles. And these things right now are all open for public comment, but they are getting a lot of discussion no matter which side of the argument you find yourself. So we thought today it'd be valuable to have more of a fireside chat. Again, no fire. With Rick from our team and our guest speaker, Brian from K&L Gates. So starting with Rick, it's like, I don't know, Rick, did you write this intro for you? I don't know. There's a lot of words here. Okay. So Rick has been with Haskell almost 30 years. He spent his career helping companies navigate the realities of being a public company. He's worked with entrepreneurial businesses preparing for their next stage of growth, as well as mature organizations facing increasingly complex reporting and regulatory requirements. So whether it's an IPO, an acquisition, a new accounting standard, or an SEC issue, Rick has a way of taking topics that feel overwhelmingly complicating and making them practical and manageable. And it's my pleasure to say that I've been working with him his whole 30 years here since he joined the firm. So joining Rick is Brian Daly from K&L Gates. Brian is an associate in the firm's capital markets practice and advises both public and private companies on securities law, corporate governance, capital markets transactions, and M&A matters. He regularly counsels public companies on Exchange Act reporting, proxy requirements, Section 16 matters, and stock exchange compliance. So Brian brings the legal perspective to many of the same issues that Rick and the rest of us at Haskell White encounter from the accounting side. So I think having both viewpoints represented will make for a really strong discussion. So I'd like to invite Rick and Brian to take it from here.
Thank you, sir. So when we envisioned a fireside chat, we envisioned a couple cozy chairs up on the stage, but this is what we end up with. So we're gonna do the best with what we have here. Wayne, do you have the clicker? Oh, this is the guy. Okay. We're going all fancy. Gotcha. Thank you. Okay, so welcome to everybody. I know it takes a lot of time and effort to get here, so we do have an award to give out to the longest drive for Melissa. So Melissa, especially thank you for coming up from San Diego. We actually have, I think, around 30 people online virtually, so a warm welcome to everyone who's attending virtually. We do know there's a World Cup game this morning, so if you need to split screen us later on, we'll understand why. But again, welcome to everyone for being here today. There's a lot of change going on in the world, and the realm of SEC reporting is no different. And I think before we jump into some of the proposed rules that we want to dive into, I think it would be a good use of time just to kind of refresh and kind of ask ourselves, how did we get here? And why are these proposed rules being put forth? So a little bit of the why before we get into some of these rules. I think we've all heard anecdotally the number of public companies in the US has been a trend that's been going straight down, and it's been that way for quite a while. This is just one graphic that depicts that. This is actually, if you can see the bottom axis, it's about a 25-year look back. This is a chart that shows listed companies, so this would be folks that are listed on the major exchanges, so maybe not including some of the bulletin board companies. But whether you're looking at SEC registrants, listed companies, the story's going to be the same, which is, again, a trend that goes down. You can see at the beginning of the graph a very rapid turn down. So this graph starts out at about 7,000 listed companies. Anybody know immediately after, you can see after 2000, 2002, 2003, 2004, we see a very significant drop down. Anybody guess what's going on in the world at that time? SOX, yeah, Sarbanes-Oxley Act. President Bush signed that into law in July of 2002. So again, a lot of those rules were put forth in 23. So again, that made it really hard to be a public company, and you can see that depicted in the graph. There's a little bit of positive news as you get past 2020, and I think the low point for public companies in the US was around 2020 after COVID hit. Some folks didn't make it out of COVID, and that decreased the numbers. There was really no IPOs going on in that moment. So we saw a drop in public companies. Then we saw a little bit of spike. You can see on the graph here, 2022, 2021, 2022, 2023. What was going on in the world at that time that might show a trend upward in public company interest in the US? SPACs, yeah, everybody remembers SPACs. It kind of turned into a dirty word. But again, you're exactly right, David. There's a lot of SPAC activity, and you see that reflected in the public company numbers. And then, of course, that fad kind of died out, and you can kind of see that we've leveled off again. So this is the data the SEC is looking at when they say just interest in being a public company in the United States is trending down, and it might be time to take some action. The next graph here is specific to IPO activity. So this is the same time period, so roughly 25 years of data. And it's an interesting chart in the sense that you can see in moments of time where there's some momentum going up, and then it's followed by some momentum going down. And that seems to be a little bit of a repeated trend in this chart here. And you can see around the years 2021, 2022, you see that little blip, and again, that's the activity we see from the SPACs that David had mentioned earlier. But again, you can see the chart here, not super inspiring in terms of public company growth in the US. So that's the data that the SEC is looking at, and when you hear stories about declining interest in being public in the US and how hard it is to be a public company in the US. So this is kind of the data that supports that. And what we've seen from the SEC up until this point is a lot of incrementalism. Just little tweaks to the rules, trying to make things easier, a little tweak here, a little tweak there, but nothing really foundational. And I think when we get into the program and do a little bit of Q&A on some of these proposed rules, you'll see that there's some foundational changes that the SEC is putting forth here that they hope to really inspire some of these numbers higher. Before we go into the rules, a couple definitions I want to make clear that we're all on the same page on, because the SEC is going to be changing these definitions. So let's just make sure that we're clear on what some of these definitions are here. So this is a chart right off the SEC's website. It's confusing as heck, and it really depicts SEC filer status. So you can see on the left-hand side, you'll see some familiar terms: non-accelerated filer, accelerated filer, large accelerated filer. So that designation dictates whether you need to have an internal audit, or I'm sorry, a SOX 404 audit done. So an audit of your internal control over financial reporting, SOX 404B. So if you're accelerated or large accelerated, you have to have the internal controls audited. If you're non-accelerated, you don't. And then it also dictates the timeline that you have to file your reporting obligations. So a non-accelerated filer, for example, you have 90 days for your 10K and you have 45 days for your 10Q. If you're an accelerated filer, you have a shorter timeline. If you're a large accelerated filer, you have an even shorter timeline. You have 60 days to file your 10K. So that's the framework that the SEC gives us today. But then they've overlapped under the theme of trying to be a little bit more accommodating to small public companies. They came up with an idea called a smaller reporting company. Now, the smaller reporting company, if you qualify for that, what that allows is just reduced scaled disclosure. So that's a wonderful thing. And when we say specifically, what do I get if I'm a smaller reporting company? What kind of accommodations do I get? Well, they're significant. It means that you only have to have 2 years of audited statements in your filings and not 3. It means that your compensation section of your 10K can be much reduced, so you don't have to do compensation discussion and analysis. You only have to list 3 named executive officers and not 5. You can reduce some of those pay versus performance and pay ratio disclosures that are required for the larger companies. So it's a significant accommodation. Also, your business section, your MD&A section, and your risk factor section can all be reduced. So if you qualify for a small reporting company, there's significant reductions in the reporting burden for you. The problem is, look at how convoluted this is, because the SEC has given companies really 2 ways to qualify for these and determine where you fit in this reporting regime. One is public float and one is revenue. And I think you can see the confusion in the middle 2 lines here, because both of those are accelerated filers, and one is a smaller reporting company and one is not. So trying to figure out where you fit in all this can be hard and confusing. And this doesn't even include the EGC consideration. So in 2012, we got the Jobs Act, and the Jobs Act came up with an idea of an emerging growth company. And so that had its own set of rules. So public companies have to navigate, am I accelerated? Am I non-accelerated? Am I large? Am I a smaller reporting company? Do I qualify as an EGC? How do I figure all this stuff out? And how did we get here? Well, because we've just done incremental changes as time has moved on, trying to figure out ways to make it easier to be public. So that's the regime we have today, and that is part of what's driving some of what you'll hear today with the new rules. How do we make this more simple? How do we make this more easy to digest for public companies? Okay, let's take a little polling question here. If you're online, please do answer the polling questions. That's how you qualify for your CE. So between 1955 and 1970, so going back a little bit, issuers filed semi-annual reports with the SEC on Form 9K. True or false? How about the trues? Anybody? Anybody think that's a bunch of baloney? No, it's actually true. It's actually true. Yeah, so the first proposed rule that you'll hear is on semi-annual reporting, but you know what? We've done it before. And again, 1955 to 1970. And not that I want to be too praiseful of the SEC, but anybody that is in the room that's kind of a financial reporting nerd and you want to learn a lot of interesting history about the reporting regime that the United States uses, the preamble to the SEC's proposed rules, there's a lot of really good history in there about the start of public company reporting. Like I say, this little fact came out of that preamble. But if you're really interested in the history of financial reporting in the US and how we got to where we're at today, there's a lot of really good, interesting data and history in the SEC's proposed rule. Okay, so we're going to go to our very first proposed rule. Maybe just a quick show of hands. How many of you have heard about this first proposed rule, which is the proposal that public companies can opt in for semi-annual reporting in lieu of quarterly? Is that pretty well known? So I think if there's any rule that's gotten some press and some media attention, it's been this one. And so just a couple of recaps here. So what this proposal says is that if you're a public company and you're reporting quarterly, so again, Q1, Q2, Q3, you can actually elect not to do that anymore. And instead, you can elect to report on a semi-annual basis. So that'd be at the end of your second fiscal quarter. So if your calendar, that of course would be June. But you can essentially substitute those 3 quarters for one semi-annual report. The interesting thing about the proposal is the SEC is going to let the registrant choose. So we just went through that regime of accelerated filer, non-accelerated, smaller reporting company, revenue, benchmark, market cap. None of that matters here. The SEC is not putting anybody in any box. What the SEC is saying is, you know your company best, you know your investor group best, you know what your plans are and your intentions are as a public company. So guess what? You get to pick. You want to file quarterlies? Great. You want to file one semi-annual report? It's up to you. So that's a pretty significant shift. Again, usually the SEC mandates filers by some type of measure, whether it's revenue or market cap or public float. But here they're going to let you choose. So that's interesting. The election will be made on an annual basis. So it's not permanent. You can change your mind. And you'll do that. We'll talk about how you actually would do that. Time periods are going to be the same on the semi-annual report as they are for quarters. So 40 to 45 days will be the same. The materials that will go inside the semi-annual report, which is going to be known as a Form 10S for semi-annual report versus 10Q for quarter. The materials will be the same. So you'll still have financial statements. You'll still go through a review by your CPA firm. You'll still have MD&A and all the typical context that's in a 10Q. So none of the text of the Q is anticipated to change. But again, pretty significant change in what the SEC is reporting and proposing here. So let's ask Brian for some advice here. So first of all, maybe let's talk about the mechanics of how do we do that. So if you like what you hear and you've had your discussions with your boards and your audit committees and you say this is something we'd like to do and we'd like to do a semi-annual report and forego the quarters, the mechanics of doing that, how does a public company going to make that election, Brian?
So with the election, it's going to be pretty easy. 10K, you're going to check a box saying that you're electing to do semi-annual reporting. So every year you'll have to do it. It's annually. And then if you mistakenly check the box and you decide at that time that, okay, wait, actually we didn't want to do semi-annual, or you forgot to check the box, you'll also be able to fix that. So you need to do it as reasonably practical as soon as you know, or, but at the most it has to be before your first Q is due.
Mm-hmm. So let's just take an example for, say, a December 31 company. So let's say 12/31/2026. So this year, let's say we want to be a semi-annual reporter. When we file our 10K for 2026, we would do that in March of 27. There will be a checkbox on our 10K that we would then elect semi-annual reporter.
Correct.
And that is your signal to the world that you are going to opt out of the quarters, you're taking semi-annual report, and everybody will know from that point forward.
Yes.
Yeah, okay. So what's interesting there is if you, like most companies, like a lot of companies, if you file toward the end of March, your 10K, your investors won't know you're opting for the quarterly reporting, to opt out of the quarterly reporting until March. Your Q1 report would be due in the middle of May. So that's not a lot of time for the investment community to know your intentions, right? That seems pretty
Correct.
tight. Yeah, okay.
That's actually one of the reasons why they recommend that you engage with your investor base to ensure that they're kind of up to date, because as we'll discuss, there could be issues from that.
Yeah,
So.
okay. Let's talk about the pros and the cons of maybe taking on this proposal and accepting it. So what are some of the benefits? So if you think about your own companies too, what are some of the benefits that a public company can achieve? Why would they want to avail themselves of the semi-annual reporting?
So I think there's, like, the main one, and the one that I think most people think of, is you save money. I think the SEC estimates it's around $330,000 for your Qs. So it'd be for 3 Qs. And then for the semi-annual, they're looking at, I believe it's $132,000 they're estimating. Yeah. So I think it's $198,000 difference. Mm-hmm. Also, there's, having to do it quarterly, management's distracted during that time. Mm-hmm. You have a lot of things going on. Also, by doing semi-annual reporting, you're also going to get the ability, it gives management an ability to focus more on the long term instead of the short term. And there may be benefits with the fact that by not doing it every quarter, there might be a little less volatility in the stock, because every quarter, obviously when you're reporting, you can see drastic shifts at that time.
Yeah. What I've read is, and I think we've all heard public companies being accused of this, is the quarterly reporting regime that we use in the US. It encourages short-termism, right? Like, you're only as good as your last quarter, versus a solid business plan that focuses on long-term. So maybe break some of those habits of quarter to quarter and look a little bit more long-term at the business. So, and on the cost, the numbers that Brian just railed off in terms of the costs of reporting, remember, when the SEC puts forth a rule, they are required to measure the economic consequences of what they're doing. And again, something that's really good, if you actually pull up the actual SEC rule on this, they explain all their math in there. And for me, I don't believe much of the math that's in there. It's kind of crazy, some of the numbers that they put in there, but at least they've tried to quantify the savings, and the numbers that Brian quoted is what's in the SEC rule in terms of the anticipated savings. But again, we all know, everybody in this room that prepares quarters, you know how hard it is, you know how much time and effort it takes from the staff. The auditors have to come in, they're expensive. The lawyers need to come in, they're expensive. If you're hiring external consultants to maybe help on an accounting transaction or just to support your team, that's expensive. So I think most people would agree that there's certainly some dollar savings, and that is what the SEC hopes to achieve here. Because again, remember, the ultimate goal the SEC has is how do we motivate more companies, more private companies to want to go public, and then once you are public, how do we encourage you to stay public? And you can see that there's certainly some dollars and cents at work here. How about the flip side of that question, which is, what are the risks associated with accepting this proposal and becoming a company that chooses just to file semi-annual reports when you've got a whole history of filing quarterly reports for however long you go back?
So I think one of the main ones, and it kind of goes back into the investor relations, is your investors may not be happy with it. They may want information sooner than later. Especially with more of the institutional investors, they tend to run their models based off the quarterly numbers, increasing it to 6 months. They may not have as much faith in the numbers, which can also become an issue when it comes to reporting. So there would be that one, which then brings up other issues, which is, most companies have financial agreements, credit agreements, other agreements that require quarterly reporting. So they still may have to report quarterly, and that may get rid of some of that benefit that you're getting cost-wise, because you're going to still end up having to do, similar, not to the same level, but similar financial reporting, and which would then be usually filed on an 8K. Information asymmetry is going to be one. You're going to see that the company is going to be holding on to information for 6 months instead of releasing it every quarter. That could lead to insider trading issues with the company trading when it has material information. Could also cause speculation, since information is not getting released as much. Investors may speculate a little bit more. That speculation may lead to a lot of volatility in the stock.
Yeah, good points, good points. As taking a view from an auditor, we can look around the room and whether it's David or Paul, Kelly, Danielle, Diane, when we go into our clients and we do quarterly reviews, we think it's a really great thing because we're looking at transactions, especially if you have a very active client that's raising money and maybe there's convertible debt or preferred stock or warrants, and maybe there's a license agreement that happens in a particular quarter. And when we're in there and we get to work through those transactions with our client, the quality of financial reporting is greatly improved. And one of the reservations I have with this rule is that third-party check from the auditor is going to be absent now. And one of the things I worry about is what if. So what if there is a transaction like that in Q1? And what if the company gets it wrong? And what if they issue an earnings release in an 8K or something like that? And then you get the semi-annual review later, auditor comes in and says, hey, guess what? That transaction you did in Q1, guess what? It was wrong. And then where are you at? So, and I think it's also, just as a reminder too, smaller public companies, they're the ones that tend to report the ineffective internal control over financial reporting. They're the ones that typically have the material weaknesses. So you're going to let those companies go through those transactions without a third-party check and then potentially release those numbers, revenue numbers, earnings numbers, release those to the public. And that's a significant reservation I have.
Yeah, and I think there is also, when you were initially kind of discussing the background, I think what you're going to see is so before, when it's smaller reporting company, larger accelerated filer, you had what you were supposed to do. They told you very specifically. Now companies have to make that decision on their own. So there is that possibility of making the wrong decision and that's going to be on the company more, when before they could at least go, well, I was following the rules. There's a little bit more of a buffer there.
So let's talk about Form 8K. So one thing that's clear in the SEC proposal is the SEC is really propping up the 8K. Because if we're not going to be filing quarterly reports anymore, we still need a method to communicate to our investors. The SEC thinks the 8K can fill that role. The SEC makes a point in the proposal of saying, look, if you look at how the 8K was used many years ago and look how the 8K is used today, so many more things are required to be disclosed in an 8K today than in the old days. And again, some geeky financial reporting history. The 8K used to be due 10 days after the month that a transaction happened. So if you did a transaction on the first day of the month, you wouldn't be required to report that on 8K till 10 days after the next month. And look at the regime we have now, it's 4 days for most things, right? So the SEC's point is, look, the 8K is much better now. If you have something you need to communicate, whether it's earnings or a material event, use the 8K. You don't need a 10Q. Use the 8K and communicate that way. So it seems like the 8K is being elevated in prominence here, and that document might become more important. But in the scenario I laid out, Brian, do you see any risk to a company if their plan, and some folks refer to this as maybe a hybrid method where we're going to adopt semi-annual reporting, but we need to communicate with investors, so we're going to use 8Ks to do that. So for example, earnings release for Q1. Or maybe we had a revenue number we want to get out there. So we're not doing a Q, so we don't have a Q to file, but I want to communicate to the investors what my Q1 earnings are, or this revenue number that I have for Q1. I'm going to do that in a press release. Now, again, the SEC, the Securities Act doesn't mandate companies you don't have to do a press release, you don't have to do earnings release, you don't have to do any of that stuff. But if you do, it has to go in an 8K. So what are the risks to a company if they put out a number in an 8K? Again, no auditors looked at it, but what if it's subsequently found out that it's wrong? Is there a risk to a company in that case?
Yeah, I think there's, and that does kind of raise a lot of questions for companies. So first, some companies may choose to do the hybrid, as Rick was saying, but you also may just have to file an 8K because you're sitting on material information. So similarly, anytime you have material information, you have to get it out there. You have to determine if it's material. If you make that mistake and you don't, then you've created an admission, you're now liable. Similarly, if you put the information out there in an 8K, but you don't put correct information, again, you could be liable. So there's gonna be that risk where with, because with a 10Q, you would have your auditor come in and, not do a full audit, but they're gonna look over your numbers, double check everything. Now you're not gonna have that. Or you may, but then again, you start reducing their benefit from the cost side of things. So I mean, that would probably be the biggest risk with the 8K.
Yeah.
Okay.
I think one of the things we can look for, because a lot of folks are asking us, like, what do we think we're going to do? So if one of our clients says, hey, we're not going to do quarterly reports anymore, but we still want to have some assurance that the numbers that we're booking for Q1 are right, how can Haskell & White help me in that case? There's lots of things that we can do. So it can be some kind of consulting arrangement where we come into the quarters. Now, again, we're not going to do a review, but there's certain transactional work that we can review just to make sure the company's doing the right thing to get the reporting right. In our business, we talk a lot about continuous auditing, and this is a wonderful opportunity to introduce that discussion again. So why is it that auditors just show up at the end of the year and do all the auditing for the whole year at the end of the year? It doesn't have to be that way. Why not go in at the end of Q1 and actually perform audit procedures on some of this data? Again, we're not issuing a review report, not issuing an audit report on Q1, but we're performing audit procedures on some of those transactions. The audit has started. It's an idea of continuous auditing. So again, there's lots of ways that we as a profession can help public companies get the data right before it goes to the public. And that's really, I think, what we all want. So Brian, in the final analysis, when we think through this idea of semi-annual reporting, is this really going to move the needle that the SEC wants to move, which is this going to help public companies stay public? Is this going to inspire more private companies to go public?
So, as typical lawyers say, maybe. So I think only time can really tell. I think there may be some changes, amendments based off of comment letters to this, just to kind of hone everything and get it all perfected. But I think generally, in the stuff we're going to talk about a little bit more in a minute, I think generally the move to make it less burdensome on the disclosure and the cost, and just trying to make it easier for companies to raise money, because I think that is probably one of the biggest issues. You know, companies are looking at, should I go public? And then they talk to their friends who are, and they see the difficulties that they may face. By making it easier, I think that will help in a lot of ways.
And for me, I think taken in isolation, I don't know that this moves the needle much, but this combined with the next rules that we're going to talk about, plus the rules that we think are coming still, I think when you look at the final body of work, when we're sitting here a year from now and we look at all of the changes that the SEC's put forth, I think that will move the needle. And I think the SEC, whether this works out or not, I think the SEC deserves a lot of credit for being bold. This is not some of the incrementalism that we've seen in the past few years about just tweaking this rule, tweaking that rule, and hoping that things work. These are significant changes that they're putting forth. And so I think just giving the SEC a little bit of credit for doing something bold, I'll high five them for that. Okay. Okay, so we have a question for you all now. So polling question number 2. So given what you know at this moment and given what you've heard, would you recommend that your public company elect semi-annual reporting? So if you're online, please answer that. How about a show in the room for your companies? Do you like the idea of semi-annual reporting? Yeah. Anybody opting, thinking that they don't want to? Wayne, do we report quarterly? Yeah, there's a few. Yeah, you can certainly see there's a lot of benefits, but there's certainly some pitfalls too. I was listening to a podcast earlier, and the chief accounting officer at Marvell Technologies, which is a large chip maker, he said something that was really smart, which was the encouragement he has for companies is to really think holistically. It's really easy to look at the dollars in this thing and say, boy, we can save money, we should do it. But that is not the complete analysis. You really do need to step back and look holistically and think about investor relations, public relations, what's it going to do internally to your operations and your cadence and your discipline in terms of closing. So holistic view. Yeah, we have a question from the back.
Actually, some of them, people that said no, they wouldn't elect semi-annual. I'd be curious if they're going to say the same reasons you did, or if they have additional reasons. If somebody wanted to say, I'm curious why they would stay with quarterly.
Yeah, so the question was, why would you choose to stay quarterly? And is there anyone that would like to share their opinion?
Sure, I'll be happy to. I mean, I have kind of two kind of clients that I run into, the ones I don't worry about and the ones that I worry about. And it's that second class that I would be really concerned about. I mean, I run into those that don't close their books, they don't reconcile bank statements until they have to file something with the SEC. So, you know, I mean, there's delineation there, and sometimes they need an adult in the room, which is by default with the SEC, I guess.
Yeah, so the response was, yeah, not all companies are created equal, and companies that have good disciplines, good processes, good controls, those are the ones that will probably be okay in the semi-annual world. The ones that have a very lean accounting department, maybe aren't staffed up in terms of quality and capabilities and size to get their arms around the quarterly numbers. Yeah, those are the ones that maybe they need that discipline. Wayne, you got a comment?
Yeah, I mean, just might point out that all this stuff, the SEC obviously is going to comment letters and may take a while to get approved, but
Right.
we don't know yet what the accounting standards and auditing standards might shape out to be, because those will be the next things that have to be written. So,
Yeah.
not to counterpoint with your comment about not having to do reviews, we don't
Right.
know what the PCAOB's response might be yet.
Yeah. Yeah. Which again, and honestly, counterpoint to your counterpoint, they might not do anything, right? We have a standard on interim reviews, and the SEC may say, hey, you have your standard, you're going to follow 4105 just like you always have. So there are no new rules. Follow that one. So yeah, so still a lot to be written. And maybe we should have said this at the beginning, but just so everybody understands where we're at in the process. So what Brian and I are talking about today, these are proposed rules. So the SEC has publicly proposed these rules. The process that the SEC follows is they leave the proposed rule out there for usually about 60 days for the public to comment on. Then after the 60 days, they close the comment window and the SEC aggregates all those comments. And they review those comments that is made by the public, or they have Claude or ChatGPT review all those comment letters. We'll be skeptical on that one. And then what they'll do is they'll decide, based on all of that feedback, what they want to do in their final rule. They can make changes. They could not make changes. They could abort the rule at that moment in time. So there's really no way to know when we will get a final rule. It will all depend on the number, the volume, but also the sophistication of some of the comments that are written. This is all public information. So actually yesterday I went and I looked, I said, okay, how many people are commenting on the semi-annual reporting rule? Because again, you can go to the SEC's website and find this information. I think, based on my quick math, I think there's about 1,000 comment letters that have been submitted so far for semi-annual. And the window stays open, I think, till July 6th or something like that. So if you're interested in the topic, if you feel like writing a rule or writing your response, feel free. The SEC would love to hear from you. But there's about 1,000 of them. So there's going to be, I think, a pretty good amount of data for them to go through before they make their final rule. So when we will get a final rule, we really don't know. And of course, we don't know what a final rule will look like. Partner David Brownstein, I think you looked this up on Kalshi last week. What is a Kalshi odd on when we're going to get a final rule?
This was around the Q1 audit committee date time, so it was maybe a month or so ago, but it was something like 68% chance that the rule would be in effect by April 1 of 2027. So people are thinking better than 50-50 chance that your first quarter of 27 will not need to be filed.
Right, okay. So for those of you that are interested in betting, there you go, there's the odds. So. Okay, we're going to move on to another proposed rule, and this is actually a companion set. There's actually kind of a brother-sister rule here. For me, these are a little bit more prescriptive. I think when we talk about semi-annual reporting, there's pros and cons, and there's a good debate to be had there in terms of what's best for your company, what the risk and rewards are. I think these two rules here, they're just a little bit more prescriptive in terms of this is how the world is going to work if these rules get passed here. So the first one on registered offering reform, and the second part of this is on public company reporting reform. So let's talk about the registered offering reform first. The first thing I think we want to mention is Form S-3 eligibility. So right now, if you're a public company, to be eligible to file on Form S-3, you have to have a $75 million public float. And maybe, again, just to check in, public float, that is essentially the market value of your non-affiliated shares. So essentially, if you take your trading price times the shares you have outstanding, that's your market cap. You would deduct from that any shares held by affiliates to come up with your public float. That would be the calculation. So 75 million in order to sell an unlimited amount of securities on Form S-3 and a 12-month seasoning. So essentially, if you're a newly public company, you can't use Form S-3. You got to wait. You got to season for 12 months. So the SEC wants to scrap both of those requirements. So they want to scrap the public float requirement and the 12-month seasoning requirement. And so there you can see 60% of eligible issuers, an increase of 60% of eligible issuers on Form S-3, which would allow more companies to file a shelf S-3 and pull it down whenever you need it. For example, in an ATM transaction. So something happens to your stock, it starts ramping up, you have an ATM, you can pull down shares and sell into that strength immediately. So it gives companies a little bit more control over timing of when they raise money. So what are the new requirements going to be in order to use a Form S3? I was joking earlier, you pretty much just have to be breathing and you can use a Form S3. Okay, it's a little bit more complicated than that. But essentially, if you're a current and timely filer, so if you're filing all of your Ks, and whether you file Qs or a Form 10S, you file 8 Ks on time. Ooh, boy, time's flying by.
Well, 5 minutes till the question.
Okay, thank you. Yeah, so it's a pretty easy benchmark. So keep yourself current. Don't have any bad actors on your team. So if you have someone who's been in trouble with the SEC, that would disqualify you from using Form S3. And if you're a blank check company or a shell company, you can't use S3. So again, keep yourself current, stay away from bad actors, and if you're not a shell company, you can use an S3. So really, really great requirements here. And I'll tell you what, the SEC is trying to make this so easy for companies. They're even saying, okay, but you know what, if you did miss your 10K filing deadline, or if you did miss a 10Q or a 10S, if you just missed it one time and you only missed it by a couple of days, you're still good. So they look like they're bending over backwards to try to give everybody the chance to use an S3 to raise money. They're also going to allow, I don't think we have too many what we call well-known seasoned issuers, or WIXIs, in the room. That would be a market cap company of over 700 million, market cap of over 700 million. But do you know WIXIs today, you can actually file an S3 and have it go automatically effective. You don't wait for the SEC. If you're a WIXI, you file your S3, those shares are automatically registered and they're automatically effective. And you can start selling them and trading them. So the SEC likes that idea, and they want to make that idea available for more public companies. So there will be new thresholds on who can actually use that tool, which is called an automatic shelf registration. So you file it, it's effective. You don't have to wait for SEC review. You don't have to wait for SEC effectiveness. So again, how do we make it easier for public companies to raise money? That's certainly one way to do it. They're also modernizing Form S1. So Form S1 is a longer form. They're allowing more items to be allowed to be incorporated by reference. So that's incorporating by reference for future filings and also for past filings. So they're trying to make a lot of accommodations here, all geared around making it easier to access capital. A subnote to all of this is some blue sky exemption. So sometimes when you register securities, you may have to comply certainly with the federal statutes, but sometimes states might have different statutes. And so that's when you need guys like him and law firms behind you to figure out the state requirements. The SEC's position is, hey, let's streamline this a little bit, and if you can be exempt, if we can figure out a way for you to comply with the securities law for federal purposes, it's going to be good for state as well. So you're not going to have to run through 50 different sets of rules in addition to your federal statutes. So again, simplification here. So question for Brian here. What do you like about this proposed rule? Whoops, let me go back here. I don't want to do that yet. What do you like about this proposed rule? What's exciting? What's impactful in this new rule for public companies?
Sure, I think the two big ones are the S3 changes and the changes to the WIXI. The S3 is huge. A lot of companies like to use its S3s. They make it a lot easier, a lot more cost effective. So the ability for people to use it. So as Rick was talking about earlier, you have to have a $75 million float currently to use it. If you're below that, they have this thing called the baby shelf. And the baby shelf allows you to use 1/3 of your public float over a rolling 12-month period. I have a lot of clients that doesn't really work well for raising funds. In fact, it handcuffs them in a lot of ways. So this these changes really help because they allow them not to be so handcuffed. It's easier to raise capital, which that's why companies go public, or one of the main reasons. So yeah, the big one is getting rid of the public float requirement. Another one that they have is the fact that there was, if within a 12-month period, if you had a financial covenant like defaulted, and I've had clients where you have covenants inside your credit agreements, that are very tight, and they may be in default. They may be working with their creditor because they were, but then that's forced them to not be able to use the S3. So that they're removing that requirement is also very helpful. And then the WIXI one, they're basically doing away with WIXI. Only foreign companies foreign private issuers will have that title, and will still have to follow those rules. The new one is a seasoned eligible listed issuer and a eligible listed issuer. And basically to be able to do the automatic, as Rick was talking about, the automatic effectiveness of your S3, you just need to have had 12 months, you need to be Form 3 eligible and current, and have 12 months of seasoning. So you have to have been a public company for 12 months. Which is huge because previously the requirements for WIXI, 700 million public float, or you have to do, I think it's $1 billion or $3 billion in non-convertible equities over 3 years. So it's very helpful because basically after 12 months, as long as you're Form 3 eligible, you're able to file that S3. It's going to be automatically effective. That's going to be a season, so a SELI, S-E-L-I. The ELIs, the eligible listed issuers, they just need to be Form 3 eligible. They'll be able to take advantage of the pay-as-you-go fees. So on an S3 for a WIXI, they're able to just kind of pay as they go. Also, eligible listed issuers will be able to take down or add securities onto the S3 by post-effective amendment, which will also be very helpful. But I think those are the two biggest ones because I think with talking to clients, one of the main things they're always looking to do is raise capital, and these will make it a lot easier, these amendments.
Getting rid of the baby shelf is huge. If you're a small public company with a small market cap, again, as Brian said, you're limited to 1/3 of your public float. Once you raise that, you're done. You can't raise anymore. So you got to wait. Again, that baby shelf limitation is gone. So essentially, if we're reading this rule right, if you're Form S3 eligible, and remember, you just got to be current with your filings, you can't be a shell company, and you can't have any bad actors on your team, you can file a Form S3, you can raise as much money as you want. If your market cap is 10 million, if your market cap is 50 million, you can go raise as much money as you want now. You don't have any of those limitations anymore. And if you are seasoned, so if you have 12 months, you can be eligible for automatic effectiveness. So, boy, what else can the SEC do to make, other than writing you a check, what else can they do to make it easier to raise some capital? So this seems to be a very significant accommodation that the SEC is putting forth here.
Yeah, I think it's allowing the market more to control because obviously if you're going out to the market constantly, sooner or later you're not going to be able to raise funds. So instead of limiting it, they're allowing companies in the market to kind of run.
Yeah. So again, good news there. The second half of this rule really has to do with, again, cleaning up the mess that the SEC made when we looked at that slide earlier that showed the different status of filers, so accelerated, non-accelerated, small reporting company. So again, the SEC has really messed that up, so we're going to scratch that, and we're going to get rid of all of that. This is a nice little compact slide that shows where we're going with this. So you can see we are going to simplify life here, and we are essentially going to have two types of filers. You're going to have a large accelerated filer, and you're going to have a non-accelerated filer. The SEC was tricky. Underneath non-accelerated filer, they're calling it a subcategory called small accelerated. So it's really 3, but the SEC wants to say it's 2, so we'll say it's 2. Large accelerated filers, look what we did to the public float for the large accelerated filers. Yeah, and that's not a typo. It's 2 billion. 2 billion is the large accelerated filers. Large accelerated filers, remember, those are the folks that will have the internal control of financial reporting audit. So, thank you. So we went from a regime where $75 million was the threshold, and we were kind of joking earlier when Sarbanes-Oxley hit and everybody had to have internal controls audited. Then we said, how about 75 mil? Now we're up to 2 billion. But when you look at some of the stats, you can see what the SEC is doing here. So the large accelerated filers in the US, they comprise 94% of the total public float. Total public float, 94%. And that was before the SpaceX IPO. Da-dum-bum. And then also 60 months of seasoning. So if you're a company going public and you have a very significant public float, you're not going to have ICFR audits done for the first 5 years. So a little bit of EGC kind of blending in there. So you get that holiday to get used to being a public company. So again, not a lot of ICFR audits being done under this proposed structure. So let's look at the non-accelerated filer. So public float less than 2 billion, or you have less than 60 months or 5 years of seasoning. Those companies are only 7% of the public float, even though they comprise, as this slide says, 81% of the public companies. So most of them in terms of quantity, but the public float is so small for those. So again, you see the SEC really focusing in on really market cap and protecting those investors in those large companies. The interesting thing here is that last group called small, non-accelerated filers. And it's funny, they're looking at an asset base here. I don't know too many SEC rules that have looked at an asset base. But if you've got assets less than 35 million, you can qualify for even more time to file your Ks and Qs, or I guess 10 Ss now. So that's all being a small non-accelerated filer will do, give you a little bit more time. They found, the SEC, and again this is the proposed rule, the SEC actually studied who files late, and who files late is usually really small companies. So they're supposing they might need more time to file. So they're trying to identify really small companies, they're going to give them more time to file. So your 10K, for example, it's not 90 days for them, it'll be 120. And your 45-day queue will turn into a 60-day filing deadline. So again, just give people more time to file. The other interesting thing about this rule is you must meet these benchmark 2 years in a row. So one of the criticisms I think we all had with the old regime was, oh, am I going to need an internal control audit this year? You need to watch your market cap at June 30, right? Because that was the measurement date, your second fiscal quarter. So I'm watching my market cap. Oh, I spiked up, I hit it. And then right after year end, it goes back down. It's like, shoot, but at that moment in time, I was above it. Well, to meet these thresholds, you're going to have to do it for 2 consecutive years. And the SEC is actually letting you use a averaging of your stock price over a 10-day period, not a point in time. So not exactly at June 30th for a calendar year, you'd get to look at a 10-year or 10-day weighted average of your stock price to make that calculation. So you won't have as many companies jumping in 1 year, then jumping out, then jumping in, and then jumping out. Because of that averaging and because of that 2-year requirement, you must meet those rules for those things for 2 years in a row. So in order to be large accelerated, 2 billion, you got to hit that number 2 years in a row. So if this year I'm 2 billion, but last year I wasn't, I'm not a large accelerated. I need 2 years consecutively. Same thing on the small non-accelerated. If I'm below 35 million in assets this year and I was last year, I'm good. But if last year I was above it and this year I'm below it, I got to be below it next year in order to qualify. So 2 years in a row. That's another big change. And the SEC just doesn't want people hopping around these categories like they do today. And that's the reason there. Polling question number 3. Given the information presented, will the SEC achieve its goal of increasing IPO activity and increasing the number of public companies in the US? So based on everything you've heard today, fewer reporting, easier to raise money, simplified structure, fewer internal control audits you have to pay for and go through. How about this room? Do you think this is going to achieve the SEC's goal when things are all said and done? Yeah, we're seeing quite a few hands in the room here, and online, please answer the polling questions. We need to wrap up here, so just a couple things. We'll just do a little bit of a speed round here to wrap things up. One proposal, I think this really just came out 2 weeks ago, but the SEC proposed a formal rescission of the climate disclosure rules. So if you remember, a lot of these rules, there's a buzz going around the room, yay! But this thing was, I heard one SEC person say, this was kind of like a ghost ship, just kind of hanging out there for the last couple of years. It was just kind of drifting, it was out there. The SEC proposed rule for climate change disclosures, and there was a lot of litigation after the proposed rule. And so the SEC just has been kind of sitting back, not really paying attention to this for the last couple of years. Brian, anything significant that we need to take away from this proposed rules to actually formally rescind the rule?
No, as Rick had talked about earlier with the SEC process for approving a rule, it's similar for rescinding the rule. So it's basically just to get it off the books so that it's not sitting there so that the next administration can't go and do it. They'd have to go through the approval process again.
Okay, what do we expect future to look like? So the SEC's not done. So like I say, there's some significant movements here, but the SEC's not done. They've told us they're not done. What else can we expect in the future? You can see 5 things listed on this slide. For me, again, I think the interesting one is going to be around capital formation, IPO reform, and disclosure, what they call rationalization. We have long said in financial reporting that there's too much information in a financial statement. We have information overload. We have just built new standard upon new standard upon new standard that asks for more and more and more. When is somebody going to sit back and say, look, enough is enough. What really matters? Let's get rid of what doesn't matter anymore. Let's focus on what does. And let's not just keep patchworking these things. Let's rewrite the rules. What do investors care about? Let's build financial statements around that concept. That's what they're thinking. And given what we've seen from these proposed rules, there could be some more significant changes. But again, it's all going to be it's going to be around how do we make being public easier. Brian, any of these things strike you as particularly interesting?
I mean, crypto, there was a big, when it first came out, it was, is it a security? Is it not a security? Is it the SEC that regulates it or the CFTC? Like, which one was it? The SEC has kind of said, no, we're moving it away from us. Previously in the previous administration, there was a lot of actions against companies. Those have all been dropped now. So there's this shift to kind of normalize it. So it's just an interesting, especially if, when the nerdy side of the legal stuff of whether it's a security. But I think there will be a lot of changes in that aspect. So it'll be interesting to see. We have clients that there's these new Bitcoin, crypto treasuries where public companies are using it as a way to raise funds and bring in crypto as kind of a new strategy. And there's some companies that have literally changed only to crypto after they were something else before. I think one was Shark Game Link. So it's just interesting to see as it's progressing and to see where it'll go.
I have to make a correction. The auditors in the room sound checked my announcement earlier today when I said that we were the 15th largest firm. I goofed at. We're actually 12th. 12th. Yeah. So I did really good making that announcement with a copy of the paper in front of me yesterday, and somehow I turned the 2 upside down or something. So yeah, so we're 12th. So anyway, as we get going into the second portion here, I'd like to introduce you to Ryan Woodhouse. Ryan has been a tax partner with us he's actually been with us for several years. He's been a tax partner for the last few years. But one thing we do recognize is our public company clients in general, a lot of decisions they make are tax motivated. We have a lot of public companies who are in the R&D phase, life science, et cetera. So maybe taxes isn't the number one driving force because we've got a lot of pent-up NOLs. But anytime they're doing a transaction, acquisitions, M&A, those types of things, tax considerations certainly come into play. So we've got an opportunity to have Ryan present some information to you about the tax requirements that are out there for companies now that are doing some reporting and maybe some other considerations. So he has been here as a tax partner for the last several years. He's been with us over 20 years at this point. He advises companies and industries, including technology, manufacturing, life sciences, and real estate. Ryan is one of our few tax partners that hits a bunch of industries. We have some others that are very niche focused, but Ryan does it all, right? So he works closely with leadership teams and finance organizations on complex issues involving tax income reporting, disclosures, net operating losses, transaction planning, which would be a key item, and cross-border matters. So because he collaborates regularly with both tax and audit teams, he understands how these issues intersect and how they ultimately affect the financial statements and conversations happening in the boardroom. So Ryan has also been performing as an adjunct professor at Cal State Fullerton. He has taken a one semester sabbatical, right? So he's going back in the fall, we hope. Oh, he's on a normal routine. So appreciate Ryan following in the footsteps to go teach at Cal State Fullerton, but he can bring these things down to the college student level. So hopefully we can all understand them. So Ryan, it's yours.
Well, thank you for having me. When they first asked if I would do it, my first thought was, boy, they must not like all the people coming to the presentation because, very rarely do I actually get out and speak to a lot of our SEC clients. Mainly it's because we're doing reviews of the provisions, and it's in unique circumstances I think they actually have us come out. So I think the last time it was of a significant area would have been 2017. 2018, that was with the Tax Cuts and Jobs Act, which had a big impact on reporting requirements that the public companies as well as private companies were going to have to do, especially with respect to the corporate tax rate coming down. So there was a lot of adjustments, and I think there was a lot of uniqueness. And so we have a new one, which we're going to talk about as part of this, is the expanded reporting requirements that public companies and private, but public currently, private's not going to be impacted by this until 26, around more visibility on income taxes, what's generating the rate reconciliations between your statutory income and your book income. So there's been some uniqueness. Now, I've done a version of this presentation. This will be the third time this year. Different groups. First was internal for auditors, so we talked a little bit about, maybe a little bit more in depth in some areas. Some very tax focused. So the tax people, we probably got a little bit more in depth. And now we've got a broad base of people here. So I'm going to assume that we are not going to be getting into detail on some of these things because I don't think that's where your efforts are going to lie in your companies. So I'm going to go with some overview on like, listen, when we talk about deferred taxes, is it a necessary evil? Here we've got someone doing it for us. There was an audit of that, but I don't want to assume anything. So we're going to start off with some basic stuff. Now, one of the things I actually really like about public accounting is the broad base of people that we get to meet with. And I got to meet with some NASA engineers, this was a number of years ago, and they were explaining to me how they could take a rocket, and if you launch the rocket off of a bigger plane or rocket up in the atmosphere, it really cut down the amount of fuel that they would need. And they were explaining this process, and they said, well, it's not like it's rocket science. And I thought to myself, no, it actually does sound exactly like rocket science. So halfway through that conversation, I'm like, I appreciate their passion, but I don't know if we need to get into some of these things. So we're going to try and not make this rocket science, but make it applicable to, controllers, CFOs, people that are looking at, okay, I've got a provision. What is it that you need to know? What is it that you need to be conscious of? And especially the changes to the way that we're reporting things on the financial statement footnote, especially as it relates to the reconciliation as well as taxes paid, and it's taxes paid by jurisdiction, right? In a nutshell, they want more visibility, right? Shocked, right? Okay, here's a couple things. Usually the provision comes last, It's just the nature of what it is, right? So when we get it, it's like we've got earnings release, in a week and a half. So it is very true. 2 weeks, thank you. But it is usually, because the numbers need to kind of get nailed down. So there is a time compression there. So understanding these things makes your job a little bit better. If anyone's like me, I'm not a big one for surprises. If I go to a birthday party and go out to dinner, I don't want anyone to sing to me, no surprises. So our goal would be, no surprises. If we see things, and keep in mind, with respect to our audit clients, right, public audit clients, we're the ones reviewing it, we're not the ones preparing it. So if we can work a little bit more seamless with the team, I think that's very helpful. The second thing to be conscious of, as Wayne mentioned, I teach, and for a while it was every semester, so it was a welcome break when they said we're going to go back to the original plan once a year. And so you're a little bit more in academia at that point. And it's interesting when you talk to people of different different specialties, I being on the tax side, but there's a lot of people on financial reporting, some of the things that you see being reviewed and being researched. And so I was digging around when I was preparing and looking for what would be important for people in your position, and I came across not an article, but it was a college professor doing some analysis on restatements. Now, in the slide, it says number one reason for restatements is provision. That's maybe a little too emphasis on number one, but what's interesting is the top four reasons for restatement comprise 66% of all the restatements, taxes being one of them, right? And a lot of times I think, well, the tax provision, it's one line item, it's a lot of information, but there's a lot of subjectivity in there as well. And you'll see that when I started 20-some years ago, there was no such thing, and I'll call it FIN 48, I'll probably call it, ASC 740, I still go to the FIN 48, uncertain tax positions, right? And that was a big thing, really trying to dig into understanding, you're saying this is what it is this truly your expense? But if we were to strip some of that away and say, listen, you don't get any of the benefits, does that make an impact to the investor? As time has gone on, they've gotten simplified, right? It used to be you have to, report your deferred tax liabilities and deferred tax assets based on the underlying asset that gave rise to them, or when they were to reverse. Now it's completely different. So they were simplifying it, and now they're coming back to saying, no, the stakeholders and the investors want more information as it relates to where their taxes in that particular company are going. It gives them insight to maybe strategies, risks, geographical emphasis. So what you used to see on a rate rec of maybe this long, depending on circumstances, might be a page, and so understanding those ahead of time. Now, if you're a calendar year, you've probably already had this if you're a public company. If you're private, I believe, and I always look to my audit friends, one of the benefits of what I do, it's 2026, is that right? Unless FASB came out otherwise. So those are the reasons. And then whenever we look at a provision, inevitably, how does that rate compare to what it was in the prior years, right? What is in there? Because if I see a tax rate of 10%, well, the federal statutory rate's 21. You look at the states, it's probably another 6%. So what gave rise to that? So a lot of investors, in addition to our own internal people, really put an emphasis on that rate rec. Now, this comes the basic part. So hopefully, we don't put you to sleep like I was telling you earlier, but if we stood back and said, hey, what is an income tax provision on just a very high level? How do I get to the expense? If you've ever seen the amount of work that goes into it, it is quite lengthy. On a very simple, no subsidiary, maybe a handful of jurisdictions, you're looking at maybe 20 or 30 hours just to calculate the provision when you consider all these things. All right, so you see all the documents, but when you're actually putting the footnotes, like how do you know that the provision expense is correct? And so it's nothing more than the change in my deferreds plus the change in my current payable, right? What do I owe? And what do I have sitting on the sideline for the future, right? That's what my deferreds are. I may not get it now, but I'll get it in the future at some point. That's my provision expense. right? You forget all the other details, right? And these people, you people here, are probably not in the position of caring about the details as much as does this make sense. So we use a balance sheet approach, and it's important because when we talk about quarterly provisions, it actually uses a different approach and can yield some interesting results. But the balance sheet approach, we're really looking at what is it that I owe, what is it that I'll be able to deduct or have to recognize an income in the future. Those two numbers, when I take those changes, that is just my provision expense. Right? So it's nothing magical. Right? You can also look at it from if I take my pre-tax book income, take out my permanent differences, multiply it by my statutory rates, that's my provision expense. So you can look at this big Excel workbook, which if you've got an internal department, they have one, everybody has one, there's software for it. You could distill and not get rid of it, but you could go to the executive summary part really and say, okay, does that provision expense make sense? If you're a startup company, and I would expect zero provision expense, right? Most likely, any benefit that you would get, we'd probably have a valuation allowance placed on that until there's some kind of reason to relieve that. So just from a very high level standpoint, if we were doing this to a bunch of people that did income taxes, we would probably go into a lot of detail. Like I said, I don't think that is something that you guys would find as important in this case. Two different types. We mentioned it a little bit. We talked about deferred taxes just briefly. We said, listen, my provision expense is my current payable plus my change in my deferred taxes. My deferred taxes are just items that the government says you don't get now, but you will get in the future, or vice versa. Let's take deferred revenue. Deferred revenue, we haven't done all of the things in order to recognize that revenue in the financial statements, right? So the income tax rules say you can have a deferred revenue account, but it is a limited deferred revenue account, right? You only get it for 1 year, and then you have to recognize it. So in that case, I didn't have to recognize income currently, but that's now sitting on the sideline in your financials as a deferred tax liability. So understanding that, hey, if I've got a bunch of deferred tax liabilities standing out there, at some future point, my income relative to my book income is going to increase. So think of, payroll, for instance. Payroll, we accrue for it, the bonus. There's certain restrictions that the IRS says you can't take that until certain economic performance rules occur. That would not be deductible. That's a temporary difference. Now, the important thing is temporary differences will not impact your provision expense. Okay? They will not. They just shift between, is it a current payable or receivable, or is it a deferred tax asset or deferred tax liability? So the ones from a financial reporting, those permanent differences, the ones that truly will either get it this year or you don't, are the ones that have a direct impact on the income tax provision amount as well as the rate reconciliation. So if you look at the provision, the rate rec, and we'll get some examples in there, but you'll notice we'll say, here's our Fed tax, and then one of those items is a permanent adjustment, permanent differences, right? And that's because it directly impacts what you would report for earnings and your earnings per share at that point. Those are, I think we've talked about that, but deferred tax assets, taxes you'll save on in the future, or taxes I'll pay on in the future. Now, when I'm looking at things, and it's usually in terms of an acquisition, right? We'll look through the deal documents, we'll look through the financials, and a lot of times I think those footnotes for income taxes may get passed over. But one of the things that's important, and I feel like if we're doing this, if we can get to that point, it's a good thing, is I would like to see as many deferred tax liabilities as possible on my company's, my clients' financial statements. It means I've accelerated as much deductions as I possibly could, or I pushed off that income. That allows for us to plan for cash flow purposes. It shows that I'm not sitting there with benefits coming in the future. Right now we're talking about potential time value money. It also, if we ever change tax rates, I would want if my tax rate goes up, I might want a little bit more deferred tax asset because that's now worth more. If my tax rates are going down, which happened in 2018, I'd probably want to speed all those up, right? So although you're like, okay, here's my deferred tax liabilities, my deferred tax assets, here's what I do and don't get, I think it gives a broader or more important strategic view of what do you do next. And like I said, I see that more on acquisitions when clients say, okay, well, what's this going to look like in the future? Okay, we've got our gap side, but we can tell that all of these timing differences, these temporary differences are going to eventually turn. So, like I said, benefit from an acquisition standpoint, but I think the bigger benefit is cash flow perspective. Okay. Rick had much better poignant questions. Now, it's funny, when we do our CP and we do it, our CP providers usually have nothing to do with income taxes, right? They just put it, who's your favorite, is this your favorite music group? So this one, knowing that I get to work with our auditors quite a bit on the polling side here, who's going to be the winner of the next Super Bowl? There's only one answer right on this one. But if you know the team, I thought I would add it in there. B for Rick. David Brownstein, where's David? Unfortunately, we've got him at the Patriots amongst the Phillies. Now, anyone pick C who's my favorite? Sorry, that's probably not going to happen. So make sure everyone online has done that as well. All right, I wrote down a couple more. Let's go through. So one of the things that I like to tell our students, or my students at least, I teach partnership tax for Fullerton, right? One of the things is with the kind of work that Haskell & White does, in addition to all the public company, which I've gotten the benefit of working with a lot of people, nobody in our firm gets through without touching a little bit of real estate, which is why partnerships come into it. And I tell them, we kind of deal in grays sometimes. That's probably where we live more often than it's right or wrong, it's yes or no. And that's one of the things when we talk about evaluation allowance. So we need to get the deferred taxes down to what our net realizable value. A lot of startups will have NOLs that have been generated year over year over year. Will they ever utilize that? Who knows, right? They haven't even gotten to the point of when they're actually commercially viable. They might not have any sales. So we've got to be a little bit more conscious about should the benefit of that asset be on the balance sheet. So you've got this valuation allowance. I'm sure this one's probably not too uncommon, but there are some unique things. There's guidelines in here. Like these are some of the ones, the positive guidelines. Hey, my company's doing well. I don't need to put on a deferred tax, or excuse me, a valuation allowance against it. Why? Well, look, we've got history of earnings. That's a pretty good source of support, right? In fact, I would argue, and I've read certain things, that the strong earnings history is one of the more significant ones, right? Hey, this is what we've actually done. There's that reversal of temporary differences. Right, we're trying to say how much income will we have in the future. If we go back to that example, and we've got a deferred tax liability related to deferred revenue. We know that we get 1 year to defer that. The next year, we have to recognize it. So that reversal of that, even though it's not there for GAAP purposes, or it's still going to be there, it's still going to be a liability, we know we'll pick that up into income. So there gives us a strong support of why we should not have a valuation allowance placed against that asset. Then you get down into some others. Backlog, that's helpful. I think that one may be in the ranking of where I would put the importance of that. It's there, but I think it's a little bit lower. I think you couldn't alone argue that, hey, our backlog says X, Y, and Z. We haven't done it yet. We actually haven't gotten through that process. What if something was to happen? So I know, and in particular, I know Rick and I have spoken about this a couple times where we do have clients that they start to maybe go out of, especially if it's med device. That's a good example. It takes a while for to get FDA approval, right? You might go overseas first before you get the United States approval so that you can get the revenue. And then we start to look, we're coming out of a period of really loss. We've got a year of earnings. We've got a second year of earnings. And from an earnings standpoint, I would say industry, right, kind of looks at a cumulative 3-year pre-tax book earning. That's not hard and fast. There are times where maybe we need a 4th year. We had a client, Rick, I cannot remember, but I think we were a little concerned because of the history of losses. Then we had a couple of years of profitability. Do we release the valuation allowance? And I think we went a 4th year. I think that's what we were looking at. So some of those items, when you're looking at it, it's not just, yes, we've got 3 years, because if we've got 3 years of earnings and I have no backlog, that would presumably, maybe my sales are going down. If I've got a huge backlog, but I haven't performed on it, but I've got history of losses, I may not still feel comfortable. What we don't want is to release a valuation allowance just for the next year to be like, well, we should consider putting that back on. Because the magnitude that impacts of earnings could be quite large. You know, if I add 10 million in, let's just say 10 million in NOLs compiled at 20%, federal rate, 21, so that's 200,000. So depending on, 2 million. Depending on how much you've got as far as net income, the materiality, it could swing your rate quite large. So it's just not as simple as saying, yes, we're going to do it this way. No, we're not. Negative ones, cumulative losses. I'm telling you, that one's hard to overcome. You've proven that you haven't gotten to that point. Expiring carry forwards is another one. I haven't used it. It's not so much anymore. Right? NOLs used to be a big one where NOLs would expire after 20 years. The NOLs now, after the Tax Cuts and Jobs Act, don't have an expiration date, right? So some of that isn't as impactful anymore. History of unused credits, right? I haven't been able to use those credits. I've had R&D credits saved up, haven't utilized them all. Well, you only would use those R&D credits if you were in a position where you had a tax liability, which would be income-based. So, subjective, the cumulative loss is a tough one to overcome. And then whenever we deal with this, the documentation to make sure that we've done, especially when we have these conversations with the company, with the auditors from my perspective, right? It's something that usually should be brought up in advance, right? Nobody would like to hear, and we typically do this. Yeah. So there are times when you look at it, because what you're looking at is you're looking for to bring that deferred tax asset down to your net realizable value. Let me take an example of a capital loss carry forward for a corporation. It is not normal, right? Usually that would be I've got an investment asset in there, and that's what generated that capital loss. So you would only need a capital gain, which would be an investment asset to offset that, right? So we might put a small one against that particular component, right? Because otherwise, I've seen 2 or 3 companies, it's for whatever reason they got this. And I'm like, how are we going to either generate capital gain income, which, to be quite honest, when you look at the options, okay, if you had real estate, some of that would be a capital gain, but you would never put real estate in a corporation, right? So you would probably be looking at securities or things that you're not using from trade or business. Well, that would be like 10% of a company rather than, if you get upwards of 80, then you've got other issues with consolidation, so you wouldn't have that capital gain option. So what I typically see is most of it, without some uniqueness like that, it's probably more of an all or nothing because I've got NOLs. And then if I utilize those NOLs, keep in mind my deferred tax has now gone down. So by virtue of that, my VA goes down commensurate with that. The other big component, right? So we got our deferreds, what makes up the provision, right? The valuation allowance tends to be a big issue. And I call it FIN 48. It will always be FIN 48 to me. It was one of the, that just by indication, that probably tell you was that 2007, and as they said, I've been here for about 20 years. So I think to a certain degree, FIN 48 is kind of taken, I don't want to say a backseat, but when it first came out, it was very intensive, right? You've got all these tax positions that you've filed, and like I said, we don't necessarily just work in a binary environment, right? It's yes or no. So we have to turn around and say, okay, we being the company, made a decision that we are going to take a tax position on our return, which then feeds into our financial statements, right? Into the provision. We have to now turn around and assume that the IRS knows all of the facts, all of the circumstances, everything, and would that be sustained under audit, right? So a lot of stuff that people take are pretty straightforward, right? If we talk about accruals, the general rule for accruals for income tax purposes is it's got to be fixed, legally obligated. You've got to be able to estimate the amount, and then economic performance needs to occur depending on the accrual, but within a certain amount of time. If you don't, then it becomes something that goes to next year. That's a pretty straightforward item. We didn't pay the bonuses by March 15th, therefore it's not deductible, therefore it's an asset. But let's say we've got an R&D credit. R&D credits tend to have a little bit more risk than what people would normally think, because do you have the proper documentation? Did you make sure that it qualifies? It's somewhat subjective. So taking my tax person's hat off, which is very, here we have to be independent, on the audit side. I don't have to be independent when I'm working for my clients. I am an advocate for them. We'll look and we'll say, okay, well, how would you, if we were audited, how would the IRS look at this? All right. Well, I think we would get 3/4 of the credit. Great. So first is recognition. It's got to at least have a 50% likelihood of being sustained under audit. If it's under that, it's just nothing. Second is, if it's more than 50% likely, then how much of that should I get? Should I take the whole amount? Should I take 25%? So you've got a cumulative analysis. That usually, and I'm sure everyone's probably been through this with their advisors, but usually there's some discussion with management. Hey, here's some areas where we think there's some risk, right? It doesn't mean it's right or wrong, it just means that it may not be 100%.
The irony on the R&D tax credit and having to take a haircut because it's an uncertain tax position is every cold call under the sun. My R&D credit is too small. Way too small. We can find hundreds of thousands more dollars. It's funny.
That is funny because excuse me, I forget. Like I said, they don't let us tax people come to these things too much. So for the people online, the comment was, with the R&D tax credit and having to take a haircut because maybe it's not completely sustainable, there's a lot of people out there saying you should get a lot more for your business, and that very much is true. And that doesn't just stop there. We won't. There's a whole nother issue, but if you go back to the RTC credit, which has been a real stickler for certain people, that's all the things they would say. You could get so much more, and I've had to tell clients, no. In fact, you shouldn't get any. You know how well that goes over, right? Well, my friend and I, and so, and I think you're seeing that come back to bite people a little bit. So that is not uncommon, unfortunately. From your perspective, understanding what those uncertain tax positions would probably be helpful to mitigate some risk, right? In addition, if you've got more than 10 million in assets, you've got audited financial statements, and you have an uncertain tax position, not only is that in the financial statements, which under audit, they're going to come look at anyways, right? They're going to want to ask for it, but you actually have to disclose that on the tax return as well. So you're kind of airing your dirty laundry. And like I said, I don't see it being good or bad as much as, hey, listen, there might be some issues that we've got to be concerned with. There was a comment earlier from Brian. He was talking about crypto and some of the things that are going on. And it's funny, he's naming some of the things that one of my client has. And so we don't feel comfortable that, it's a very uncertain area, and the dollars are large enough that we're actually going to petition the IRS to give a ruling on it, and that will help from that perspective of keeping that off that list. So. Now we're starting to get into more of where this ASU 2023-9 really was starting to emphasize, and this is just what the rate reconciliation is, but it's one where we're going from here's our book income multiplied by our statutory rates, here's all of our reconciling items, and that comes down to our effective tax rate. Since we've talked a few about that, we're gonna get to that part here shortly. And I notice I don't want to take too much time, and I'm just glad that nobody is asleep so far. These are some special situations when you're looking at your financial statements, and unfortunately, a lot of these go a little bit more broad. Business combinations, if you are going to be acquiring a company, you want to get not only the deal team, which you're already probably working with, right, but you're going to want to make sure whoever's preparing your tax provision knows. Because at the end of the day, we get the information last after all of the opening balance sheet work's being done, probably multiple revisions, and especially if it's a stock acquisition, we're going to come back and say, here you go. By the way, you've got to book another adjustment to goodwill, right? So keep that in mind. Goodwill most likely is going to come out of a business combination because of generally you're going to acquire what's a deferred tax liability in that manner, right? Stock-based compensation, we just had a question on that. That's another one. That's a big one because of the 409A provisions, right? And a lot of the uncertainty. There is, with respect to the stock-based compensation, we don't get the deduction until it's exercised. And the exercising of that option, if it's in excess of whatever the value that has been derived from a GAAP perspective, becomes an adjustment directly to earnings, right? So that too would drive down your rate, right? So that would have a direct impact on it. Global intangible, and international items, those are fairly new in the last 8-9 years, post-Tax Cuts and Jobs Act. Those have a lot of moving parts with respect to the way that you recognize foreign subsidiaries' income. Tax law changes, you won't see that too much, especially the rate. You see the law change, but not the rate as much. The corporate rate I've only seen change once. That was in 2017. My understanding is it changed back in '86. I'll take people's word for it. I think I was in elementary school. All right, so it doesn't happen that much. And then the preservations of the carry forwards, one thing that is ancillary is if we've got ownership changes, those NOLs sitting on your balance sheet, seeing as a deferred tax asset, may not be good NOLs anymore because of these ownership changes. Those should be written off, not just put a valuation allowance against it. I tend to be a little bit more practical. If you're in a history of cumulative losses, why would I require you to go get this 382 statement, study done, which is quite expensive. So some firms like to emphasize that. All right, here's a more appropriate one. Polling question. Number 5, in evaluating the need of a valuation allowance, which is not a factor to take into consideration. D, yes. Where you're located, your company's jurisdiction as far as the location does not matter from that standpoint, but all of those other items do. Okay, this is the one. Income tax disclosure overhaul. Stakeholders, investors didn't find that they had enough visibility into the company's income taxes. It used to just say, here's my rate rec. There was some guidelines. There was the 5% of pre-tax book income, which was more of an SEC-related rule. People relied on that for individually disclosing some of those items. It is now mandatory under the new ASU, right? There are 8 and I'll do the next one. There are 8 categories that are identified that you need to separately report if you have it. State and local, foreign tax, enacted rates, etc. Now, in addition to that, let's take foreign tax rates or effects. If I've got any particular transaction that is in excess of 5% of my pre-tax book income, that has to be disaggregated as well and separately reported. So if I've got multiple jurisdictions where I've got taxes in 8 different states, or excuse me, let's say countries, right? And some of those are in excess of 5% of that pre-tax book income, I have to now report all of those separately. I can't just put them together into one. All right, so the whole purpose is more visibility, a little bit more understanding by the investors as to the makeup of the company's tax liabilities, cash flow. I was reading something that people are trying to now kind of blend that out and smooth out taxes for purposes of analysis on valuations, investment opportunities, where before you see your income statement says one number, you've got your cash flow statement, which says cash, for taxes paid, and then you've got your deferred taxes. They want a lot more information. But those 8, if you've got any of those 8 have to be separately disclosed, and that's just step 1. If any of those have an item that is 5%, those have to also be separately disclosed under that category. So you can imagine, I was trying to pull one up I did for NVIDIA. Their rate rec went up to, there's probably another 8 or 10 lines in there, primarily with respect to Israeli and their investment in work in Israel. So just know that it's more work. I'm sure that everyone appreciates that. Unfortunately, they were talking about pulling the funding out of the SEC and specifically FASB if they didn't pull out the ASU 2023-9. That obviously didn't happen, so this is something that is going to be here for quite some time. And I know I'm over. I'm gonna just take a couple more minutes. In addition to all of those, there's more visibility in the taxes paid in the various jurisdictions. So state taxes net of refunds now have to be disclosed. Where before it might be one number on your cash flow statement, now it's you have to disclose any company or any state tax payments that is in excess of 5% of that pre-tax book income, but you have to cover at least 50% of your total tax liability. So if I've got a jurisdiction that is 60, and then a bunch of small jurisdictions that are less than 5, that 60% jurisdiction, that gets reported separately with all the rest being reported as others. So we have some clients now where the reporting of the state tax liability and the amount paid is 12, 15, 16 different jurisdictions. Once again, I think they're looking for where is, from an investor standpoint, where is our profile? Is it overseas? Am I heavily concentrated here? That might make a difference to somebody that looks to invest in a public company. This one's just a little takeaway, controls and risks. Normally you guys and companies use an outside preparer. What I would make sure is the specialist reliance, right? Make sure you're using someone who's qualified, because even though they're really working on behalf of you, it's your provision, it's your financial statements, right? There's risk to obviously the preparer, but there's definitely some responsibility that you will want to make sure. And the last polling question, so we make sure everyone gets the CPE. This one, and I don't know if anyone caught it, there's only one term in there that really is a FIN 48 term. And so it's when analyzing the need for AC 740 reserve, what is the threshold for a tax position to be recognized in the financial statements? It's C, more likely than not, that's 50%. The other two are more tax issues, which dictate what do I have to report? Substantial authority being 40% likelihood, reasonable basis being 30%. We don't like to live in those areas, by the way. All right. There, your takeaways, keeping everyone awake. But if you wanted to go back to really what are some of the areas, if I were put in your position, right, this is what I'd look at. It's balance sheet driven. There's judgment. Work with your advisors. Get us involved early if you know that you've got one of those transactions, because it will come down to the last minute if you don't. Make sure you guys understand the expanded reporting requirements too. All right. That's it for my. Wayne, I think that's you.
I take my cue. I'll take my cue. All right, we do actually have a couple minutes if there's questions, not for me. We can direct them to the others, but I'll reserve and see if any hands are raised. Megan, are there any questions online, just so we don't leave them out? No questions online. Perfect. All right. So just a couple of reminders and some thank yous. First off, I do want to thank Megan and Leah for putting this whole thing together and arranging for the room, the food, the guys in the back doing all the audio visual, and thank them as well because they do a great job every time. Also, thank you to Rick and Brian for the fireside chat, Ryan for the income taxes. It's been a long time coming, Ryan, but you did a great job keeping everybody awake on taxes. That's awesome.
6 more years.
6 more years. So just a couple quick housekeeping items. There is a QR code on the back of the slide deck that's on your table if you want to use that to provide comments for us for the next time, or there are blue sheets of paper in the middle if you want to go the analog way and circle some numbers and give us some feedback. We do take it seriously to try to plan the next event and the topics that we'll cover. CPE, if you're looking for that, please make sure you signed the sign-in sheet at the back and see Aaliyah on your way out to get your certificates. And the valet parking is included as long as you get a little blue dot to put on your ticket. And the guys out there do work for tips, so they appreciate it if you cover them as well. So with that, thank you all for coming. Thank you for attending online. And I know we'll stay around here for a little bit if you want to mingle and maybe ask those questions privately you didn't want to raise your hand for in public domain. So thanks a lot for being here. Take care.